Well, hello there, and welcome to RozarasInvestments. I just got out of work, and I checked the news on a few different companies. Three companies that I actually care about reported earnings today, and I'm still in the process of looking at the news. So I'll start with Apple, because that's the most widely reported. So Apple reported that they did not quite sell the number of iPhones that analysts thought they were going to sell, but analysts thought they were going to sell an average selling price, an ASP, of $699 per phone, and it was way above that, way above that. It was $724 per phone. So that's an extra $25 in profit times 41 million phones, or however many they sold. So that is just tremendous. I currently don't own shares of Apple. I was planning on buying it for my daughter. Honestly, anyone that has sold Apple in the last 10 years has made a mistake. I mean, Apple is the biggest company in the world now. I've owned it. I've made some money on it, but I did not own it through this earnings report. So Apple's services industry is the second biggest revenue generator for them. And in the quarter they sold, they got $9.5 billion worth of revenue. So that's pretty awesome. And I heard them talking about it on CNBC a little bit today, just for 2 minutes before I started this video. And someone brought up a good point, like, why is the PE ratio of Apple far lower than other tech companies like Google, like Facebook, like Microsoft, stuff like that? And he said that it's priced at the lowest common denominator. And what he meant was that Apple's services and other areas of revenue could theoretically be priced at a higher PE ratio, but they need to sell the hardware, aka the iPhones, in order to get most of that services revenue. Otherwise, that services revenue won't grow if they don't sell a lot of phones. It might still grow. I mean, everyone already has an iPhone, but you know what I mean. Like they do. It is somewhat dependent on them selling the hardware and them selling the iPhones. So that's why they get a, honestly, I don't even know what the multiple is for Apple. I haven't looked in so long. Off the top of my head, I would guess it's about 19. According to CNBC, it's 17.53. After this earnings report, which it hasn't been updated yet, I assume that's going to go to about a PE ratio of 18. And while we're at it, let's just Google the EV to EBITDA, AAPL. So EV to EBITDA is a ratio that I like a little bit better. It takes debt into consideration, and it takes operating earnings without considering the stuff that no one cares about, or the stuff that a lot of people don't care about, like depreciation, like interest, like stuff like that. So their EV to EBITDA is very low. It's under 12, and after today's earnings report, when this gets updated, it's going to be even lower than this. Guru Focus says it's 11.9. So the PE ratio is in the 17 ballpark, 17 and a half, around that area. And the EV to EBITDA ratio is 11.89. And like I said, after this report, because they did earn more earnings than they were expecting to, and more earnings than a year ago, this, instead of 11.89, it's like 11 and a half, which is a very a low ratio for a good company. Just to give you guys a ballpark, a great growing company like PayPal has about a 26 ratio for the EV to EBITDA. And companies like Lowe's and Home Depot, their EV to EBITDA is usually in the 15 range. Their price to earnings ratio is usually in the 21 range, something like that. So just to give you some stuff to compare it to. But yeah, Apple is a super cheap and is definitely being priced as a hardware company, not as a growing tech company. So those of you that have owned Apple, which I know there's a lot of you, you have made the right move. I have some friends that own Apple, and I'm very happy that they made money today. I have many friends that own Apple, so that's a good thing for them. So one thing that we have to consider, and I think this is something that sometimes keeps me out of the stock, is Apple seems to be a type of stock. I think we all know at some point this is going to drop down $20 a share. People are going to get all excited about the third quarter. They raised revenue estimates to $60 billion or something like that, $63 billion. And people are very excited about Apple. And what happens is, after people get very excited about something, usually it cools off dramatically. You know, and we've seen that in so many areas of life. We've seen that in gold. Went up to 1,900 and it went down. Oil went up to $100 a gallon and it went down. Bitcoin went up to $19,000 and it went down. And even on a smaller term, you know, Apple went up to 150, then it dropped down to like, I forget what it dropped down to, like $100 a share. I mean, these things have very steep drops when investors lose interest. And I think with Apple, we know there's going to be millions of analyst reports after they come out with a good report, like this earnings report. And let's say next quarter and Christmas quarter is good too. But they're going to have very, very tough comparisons. Like next quarter is not, like the iPhone X is not going to be new next Christmas. And is going to have to compare to last Christmas. Maybe they only had not the full 13 weeks of sales, but you know what I mean? It's going to be a tough comparison. And then January, February, March quarter after that, it's going to be very, very tough comparisons because that's when the iPhone X and iPhone 8 were new. So, you know, if Apple comes out with the iPhone 9 or whatever they come out with next, it's going to face tough comparisons. And analysts are going to be saying, how can they keep up the growth if they have such a high bar to step over? So, you know, as phenomenal as Apple did, I'm probably not buying shares at this point. I congratulate everyone that has owned Apple, and I definitely give you my blessing if you are buying Apple at these very high prices at $197 a share, because it very well could go up to $250 a share, who knows? And it's definitely looking like it's going to be the first $1 trillion company. So I definitely give you my blessing if you love Apple, if you own Apple products, if you own the Apple stock. I'm actually using an iPhone right now, so you know I'm a fan of Apple. I'm not a huge fan, but I am a fan. So yeah, I congratulate all of you guys, and I'm glad a lot of people made money today. The second company that I want to talk about today is IQ. IQ has been a very, very hot stock. Let's go to the right tab. Oh, I actually just made this connection right now. IQ, and my third stock I was going to talk about is BIDU, which is the owner of IQ, or the partial owner of IQ. I didn't even realize that maybe that's why they reported in the same day. So let's go to IQ first. IQ is a partial subsidiary of BIDU. BIDU owns almost half the shares or so. They don't own all the shares because I own some of the shares. So yeah, I got these shares in the 15, 16, 17 ballpark. I believe it was the first day when they came out. Let's see. So IQ started trading in April. So yeah, I think I got it in April. It looks like it was in the 15 to 18 range. So that's when I got shares. It was pretty good, and it just started to continuously go up until June 20th. So yeah, they had a pretty good 2 or 3 month run. Since that time, they've dropped down a little bit. They've dropped down from the 40s down to the 30s. Now they've been hanging around the 30s. But yeah, so they reported earnings today. They got revenue growth, tremendous revenue growth. I believe it was 51% revenue growth year over year. And even more impressive than the revenue growth is the amount of paying users they have. This June 30th last year, they had 38 million paying users, people that are actually choosing to pay the service. Remember, IQ is like a combination of Netflix and YouTube. So the Netflix portion of it, the paying users, they had 38 million on June 30th, and it grew to 66 million by June 30th that just passed. So they added almost, 28 million users in a year. So yeah, IQ is definitely growing. And actually a couple people corrected me. It's IQYI, I think. IQYI. I'm always pronouncing it wrong. So yeah, 75% user growth year over year. Paying users. Paying users. That's the important part. Paying users. People that are voluntarily paying money to the company. So that's amazing. That's amazing growth right there. I do own the stock, so obviously I like the company. However, I don't think I would recommend this stock to people buying in right now, right at this level. Let's see what the market cap is. It's $32 a share. After hours, it's in the $35 a share ballpark. So it's up like almost 10%. So the market cap before 4 p.m., where is it listed? This is wrong. This is wrong info. It says 3 billion. I know it's a lot more than 3 billion though. So anyway, the market cap, I just think it's too high. It's, I mean, too high is a stretch because I do own the stock. Obviously, I think I can go higher. But if I had fresh money, if I had new money, I would not be buying in right now at $35 a share. And the major reason for that is because they are losing money. They're losing loads. They're losing loads. I don't know exactly what they're losing. Let me look at one of these reports right here, give you guys some idea. I was just reading all the numbers, and it's like I think it was like a billion Chinese yuan.
Who knows?
The sound came on. I don't know, whatever it is. You guys can look it up. The symbol is IQ. It was something like a billion Chinese yuan. So, you know, they're just losing loads of money. And I'm not criticizing them for losing loads of money, because a lot of companies are much more focused on revenue growth, user growth, that kind of thing. So actually, honestly, the amount of money that they're losing, honestly, doesn't even matter to me. That's why I actually don't remember it. Because the first number I checked was revenue growth. The second number I checked was user growth. And that's the two things that I wanted to talk about in the video. So the paying users growing at 75% year over year is amazing. However, while they had 66 million paying users currently, because it's July 31st today, now we have a month more of information, even though they're not reporting the next quarter. In that month, they actually gained 1 million more users. So I don't know if they're going to keep up this pace of 75% user growth year over year. They are adding more users very quickly, but I definitely don't think it's going to be at the 75% rate. Also, I think we have to realize that mathematically, if they're growing users, paying users by 75%, and they're growing revenue by 51%, they're obviously getting revenue from other sources. And that revenue they're getting from other sources is not growing as fast as they're paying users, as the revenue they get from them. So that's just a mathematical fact. So that's that. And now we will flip over to BIDU, which I did make a video about this. If you guys want to look back, I made a video about BIDU before they had the IPO for IQ. I closed the CNBC tab, CNBC. All right, so BIDU, the symbol is BIDU, BIDU, and this is a company that I do own a few shares. I previously owned options. I've made money with options. I actually made a big investment back when this company dropped down to, I believe it was $226 a share back in February. I bought 100 shares for almost $23,000. I was happy I did that, but it kind of took some balls to do that. I was in one of those modes where, like, this is too damn cheap. People are selling a great company for no reason. Anyway, after hours, the stock popped from about 247 to about 251 right now. That's probably going to change by the time you see this video in a few minutes or in an hour. But BIDU is like the Google of China. I think I've said that before, and everyone probably knows that already. BIDU is a tremendous company. They're into driverless technology. They're into artificial intelligence as far as search results, as far as predicting things for other companies and for their own search results. So BIDU honestly has a tremendous amount going on. The market cap of this company is very, very low. This is like in the PayPal ballpark. This is an $86 billion company right now. But the, oh wow, cool, it has the EBITDA right here. So, yeah, it's an $86 billion company, but because they have so much cash in the books, far more cash than they have debt, their EV to EBITDA ratio is far lower than their PE ratio. So their PE, off the top of my head, was 29 last time I looked. CNBC probably uses adjusted earnings, and they're saying the PE ratio is about 23.5. Because this number is not updated, the PE ratio is probably closer to 23. But their revenue growth is in the ballpark of 31%, and their earnings growth is in the ballpark of 32%. So this company, BIDU, is one of the most amazing Chinese companies. I actually think everybody should own a few shares. I even bought some for my daughter, even though she's very unlikely to use this company in the next 10 years. But just because that revenue and earnings growth is actually a bigger number than the PE ratio. I mean, this company is selling for a steal. All Chinese companies, for that matter. So yeah, BIDU, if I had to choose one of these three companies to put more money to work in right now, it would be BIDU. And in fact, if BIDU ever drops to the 240 mark, I'll say, right now it's about 250. If it ever drops to about 240, which would be about a 4 or 5% drop, yeah, I'm buying more shares, and I'll probably buy more options. 240. Just looking at the charts, 240 seems to be like the low point when you know, buyers collectively say this is too cheap. we're getting shares. I mean, 240 is too cheap. And on the other side, 270 seems to be too expensive for Baidu. Historically, it's hit 270 a few times, including within the last week or two. Actually, I could just check the chart and tell you exactly when it was up to 270. So let's see, July 12, it was 272. So yeah, Baidu at 250 is already down, like, give or take 9% from its recent highs. But Baidu is tremendous. They're growing everything. It's a terrific company. And because they have so much cash on the books, I mean, it's like in the PayPal category where this company is like so much cheaper than it appears. I'm looking at the balance sheet right now. Let's see. So now this isn't, oh, actually, okay. Actually, this is the March 31st quarter. I'm not looking at the very most recent one, but it's going to be in the ballpark of the same thing. Just to give you guys a ballpark, they have $18 billion of cash. So this is an $86 billion company that has $18 billion of cash. That's just amazing. So let's see how much long-term debt they have to kind of balance that out. So they have about $7 billion. Now, again, this is not the most current number, but, you know, just ballparking. $7 billion in debt, $7 billion in debt, and $18 billion in cash. So about $11 billion in net cash. So this $86 billion company that you're buying shares of, you can think of it like you're only spending $75 billion on the company. So Baidu, I think, is fantastically cheap. I'm a big fan. Every Chinese person that I'm friends with, or that I talk to, that I ask about my Chinese companies, Baidu is always one that they always know. It's always Alibaba and Baidu. That's what they always know. That's what they use. So Baidu is right up there, and I think, honestly, if I had to choose one to invest new money in, it would be Baidu. And if I had to choose one to invest new money in and leave it there forever, like I couldn't sell shares when they were up, it would also be Baidu. I think Baidu is just amazing, and who knows what other investments they have going on. I mean, they always have other stuff going on. You know, we don't read the hundreds of things that they have going on. We don't get all the news from China. They like who knew about IQ 3 years ago, and now that's a $30 billion company on its own or whatever, a stock that's up like 100%. So, you know, who knows about this stuff? I mean, Baidu has some amazing stuff going on. They got some deals with car dealerships already, and they're doing actual testing in China for their driverless cars, where they're testing on actual roads. You know, Baidu, I would say it's equally amazing as Google in America. So if you ever say that you Google something, then Chinese people could say that they Baidu something. I don't know if that's the phrase they use. I don't even know how it's pronounced in China. But the thing is, well, Baidu is also used in many countries. Google is used in many countries. Baidu is mostly used in China. But you have to remember, China has so many people. They have 1.6, 1.7 billion people. And Baidu is used a little bit in some other countries too. So they do have a tremendous opportunity for growth. And the earnings report today proved it. Revenue is growing at 31% a year, and earnings growing at 32%. Just incredible stuff. Before I let you guys go for the day, let me see if there's any newsworthy news. Let's see. No, nothing that I want to talk about that's so dramatic that I want to take up more of your time. But yeah, I just want to kind of give you guys my opinion. Again, I'm not a financial advisor in any way. I'm just a guy that's been trading. I like math. I like statistics. I like trading. I like to be on the road to become a millionaire. I like my daughter being on the road to becoming, you know, having her college money first, and then, you know, becoming a millionaire before she's 25 or 30. So yeah, hopefully you guys got something from this video. Apple, great earnings report. iQIYI, great earnings report. And Baidu, great earnings report. So I would give you my blessing on any one of those three companies. However, my personal extra money, if I had to invest today, would be in Baidu. Thanks for watching. Thanks for subscribing. I will see you guys next time. Bye.